Hi, welcome back. You're watching Money, 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 and with us we have Kirtan, Shah, founder and CEO of Credence Wealth Advisors, talking about how to invest in a rising interest rate scenario. So we've spoken a bit about, how this happens, why interest rates are rising, and what is the impact on various assets. Now we want to talk about the investment strategy. So Kirtan, let's start with those who already have existing portfolios. Do they need to make any changes?
So, very honestly, my advice may look very cliche, but I think anybody who's invested at this point in time should stick to their asset allocation. It looks very fancy for all of us wanting to do something when the markets are moving, either sell or keep buying. But ideally, the best portfolios are the ones which are really untouched, right? Now, most of us end up selling most of our investments because of a lot of panic created by falling markets. And while we end up doing that and market starts recovering, we are typically not invested, and that is where we miss the opportunity of recovery. So my suggestion really would be not to play around with your long-term portfolio a lot unless there is a serious fundamental change in what you are really holding. I think you should stick to your asset allocation and make sure that if there is a change needed in terms of your rebalancing, because markets have moved up and down and that might have changed your asset allocation, use this opportunity to rebalance and go back to your original asset allocation. Don't do a lot of things.
Okay. So what about fresh investments then? I mean, say, let's talk about equity for starters. The market itself is volatile. For those who are looking to deploy fresh money, what do they do?
So, Sumera, I think if you historically look at it, you will see that out of the 7 large interest rate cycles that have happened in the US, where Fed has started increasing rates, 6 of those 7 cycles we've had positive returns in the markets, right? But that positive return has come with a lot of volatility. So my suggestion is that at this point in time, if you're trying to infuse any new money, do not come with any short-term view of 1-2 years. You cannot play this market with anything less than a 3 to 5 year view, right? And also, in my opinion, of course, you will look at your portfolio in its entity, but I think typically you will see in such markets which are expensive and hence falling because of rate hike, you will typically see that active strategies or value investing have always done well historically over momentum strategies or probably passive investing. So this is a situation where if you don't have active or you don't have value investing in your portfolio, I think that this is the time for you to add that kind of flavor to your portfolio.
Okay, and finally, what about fixed income and gold, fresh investments there?
So Sumera, let me break the fixed income question into 3. So let's say if you have a very clear view of how long do you really want to stay invested in the market, then there are a lot of target maturity funds available out there. So if you know that you want to stay invested for 3 years, then there are 3 years target maturity funds. Just invest your money in them and forget, right? If you have a short-term view, you don't want to stay invested for more than 1 year, it is temporary parking for you. I would suggest that you stay short on the short end of the curve by investing in ultra short-term or money market kind of funds. But if you have long duration or long-term horizon of investing in fixed income right now, let's say a 3-year, 5-year view, then you should do something called as barbell. Now, barbell is a strategy in which you invest 50% of what you really want to invest at the shorter end of the curve. So let's say a money market or an ultra short-term fund kind of a fund. And you invest 50% of it at the higher end of the curve, which is, let's say, long duration funds. This strategy over 3-year, 5-year will, in my opinion, prove to be the best strategy in a rising interest rate environment, specifically for fixed income investors. On gold, I'm not sure if my view will be appreciated, but I would rather not take any excessive bets on gold. Gold, in my opinion, is a very tactical play. And, it is meant for people who really understand when to come in and come out of gold. So if you really understand what moves gold prices and you'll be able to time it well, then you try and take aggressive bets on gold. But largely, in my opinion, for retail investors, gold allocation, they should stick to what their asset allocation strategies and don't go overboard than what the asset allocation really requires you to participate on the gold side.
And Kirtan, just out of curiosity, what about small savings, etc.? I mean, would that figure?
Oh, of course. Look, like I said, that if you have a very clear understanding of when do you really want the money, then anything which is target maturity will fit your requirement, right? You know the maturity of that product. You know the interest which is predominantly fixed. So if you know how and when do you really want the maturity, always go for target maturity funds. Now, typically, what happens is while these funds, you know where the maturity is, or you know largely the rate that you are supposed to get. There are two things that you should look outside of these two things while you are doing fixed income investing, Sumera. First is, of course, the tax implication. Right now, small saving is going to be taxed very differently than a targeted maturity fund on the mutual fund side is going to get taxed, right? So if you're in the 30% tax bracket, target maturity fund on the mutual fund side is a much better option than probably a small saving, right? Assuming that we are talking about an asset which has the same returns that we are trying to compare. And also, very importantly, you should look at liquidity, right? So while you are very clear that you are going to stay invested for 3 years, 4 years, 5 years, whatever, and which is why you are doing target maturity, right? But there can be a situation that you probably might need to withdraw this money. Now, in most cases, when you do the traditional product investing, it either does not allow you to remove your money, or it charges you a penalty because you are removing it before maturity. So keep in mind liquidity and tax angle while you are trying to do target maturity fund. But for me, somebody who's in the 30% tax bracket would rather take advantage of investing in target maturity funds on the mutual fund side than doing fixed deposits or small savings schemes.
All right, Kirtan, thanks very much for your time this afternoon and for explaining, in very, very layman terms exactly how this works. So thanks very much. So, before we wrap up, here are some key takeaways from this chat with Kirtan. The easiest tool to fight inflation is by increasing rates, which is what we are seeing right now, which would thereby cut the excess liquidity. So that is the macro, right? Now, the impact of this in the short term is negative on equity and fixed income and moderate on gold. So for those with existing portfolios, Kirtan recommends to continue following your asset allocation, and for those who are looking to make a fresh investment. So the recommendation for equity is to increase your time horizon. For fixed income, stay on the shorter end of the curve, perhaps opt for target maturity funds, or like Kirtan said, follow the barbell strategy, which he has also explained. And for gold, well, basically the recommendation is to stick to what you need. With that, we're going to wrap up on this edition of Money, Money, Money. Thanks very much for watching.